Welcome to the Building Web3 Podcast. Today I have two of my good friends. First, we got Matty. He is a master of tokenomics. And then we've got Fabrizio. He is the co-founder and chief reply guy. As before we get too deep into what you're all doing in this beautiful Web3 space, let's start with Matty. How did you get into Web3 and what was your come to crypto moment?
Background before crypto was a lot of like similar related fields. I was in traditional finance, was in tech, previous founder experience, and I initially heard of Bitcoin and kind of was dismissive of it, and then eventually came around in the 2016. The presence or inevitability of a money not controlled by the government just finally clicked with me, and it made sense from an asymmetric bet, and so I got involved since then. Was involved through the 2017 ICO craze, and those are some of my favorite moments. And then the last few years, just been able to leverage my previous finance experience and coding experience to get into the space full time.
Love that. Now, Fabrizio.
Yeah, comp sci background back in uni days. My housemates they got into crypto for particular reasons, way back before the ICO craze, and they kind of hooked me on it. Played around just a little bit, but it wasn't proper until DeFi summer came around that I started spending every single day. And super fascinated about the concept of enabling equal access. I got a long background, and the whole idea that you have the internet connection and you've got drive and motivation to do some crazy things. And that's what I love about Web3.
And then Fabrizio, real quick, what are you working on specifically these days? Like, what's the mission?
Yeah, so mission for Legion. We want to fix capital formation forever. Right. You break that down. There's a lot of different problems at the moment. Some regulation, some incentive design problems, some just human and social dynamic problems. And I think that what I was mentioning before, this idea that what drew me into Web3 in the whole first space was the fact that internet connection, demand, some sort of level of ability, and then you could participate. And I think capital formation is one of the purest ways to achieve that. Talk about things around making ICOs great again. And then the day, I think it's giving people with that motivation, demand, a crack at making it.
Now, Matty, for people that are new to the crypto space, talk to us a little bit about what is an ICO if they completely missed that wave, and why do we need to make them great again?
Yeah, that's a great question. So ICOs stand for initial coin offering, right? It was traditionally speaking, when they first started out, Ethereum being the first one, it's kind of the TGE event. It's the time where these tokens come into existence, and in its purest form, literally anyone who has a wallet, right, an address on chain, sends money into a smart contract to purchase tokens. And so one of the nice aspects of it is this openness, this permissionlessness, this accessibility of, hey, this is a way to sell tokens and anyone can get in. And the tokens have not previously existed or raised money, meaning you're not getting in after a bunch of VCs or after a bunch of insiders, depending on how the ICO is set up. But obviously there's, with that permissionless, a lot of trade-offs involved.
And Fabrizio, talk to us a little bit about some of the trade-offs involved in this, permissionless nature, or that Matty was touching on.
Yeah, I'd say, that's a classic DGen thing, right? A bunch of people anon. There's no real social capital. There's no accountability. There's no level of true reputation that people care about. I know a bunch of friends. I've found adventures before. They've found adventures before under a bunch of different, anonymous names, whatever it might be. It's easy just to kind of throw out and start again. And I think that's kind of the core of the issue. So I think going back to the ICO days, right? Projects really want long-term alignment, but I think as soon as a liquid token comes live, there was never any element of credibility. Kind of classic game theory. You can do what's best for each individual in this particular case, single event games, and then just rinse and repeat.
So for people that are following along at home, maybe they're not as deep in the weeds. Talk to them a little bit about, I guess, these two different systems. And I'll direct this to Matty. So one, there's the fair launch, or there's also VC back. So VCs come in early stage, provide some initial funding. They get better token rates, and then there's a token release to the general public. Like, talk to us a little bit about the state, the two different states, the one like the more anonymous launch and the other that's more VC backed.
Yeah, I think it'd be helpful to understand like how this naturally evolved, right? So we go way back to 2017 as we're talking about. It was this kind of pure form ICO where literally anyone could participate. It's literally the first tokens ever coming onto the market that anyone ever has access to. As we said, there's a lot of trade-offs there. That drew in a lot of scammers who could abuse people, mislead people to raise a bunch of money. The scammers then drew in a bunch of regulators who tried to crack down on this and make it harder, for teams to do this, riskier. There's many cases of teams getting prosecuted, come after, and then at best case scenario, they basically have to spend all the money they just raised on fines and paying lawyers, right? So they're back to square one. So that set the stage for what we kind of currently have of teams raising more from venture capital. And the reason for that primarily is because when you raise from accredited investors, that has less regulatory risk, right, than raising from anonymous people who could include, U.S. persons who are not accredited, and then therefore you can get in trouble with the SEC and these sorts of things. So the market kind of shifted to, okay, there's less risk and there's more certainty from a project point of view, right? If you think about a project selling tokens, if you're selling tokens to just random addresses, how do you know they're not bots? How do you know they're going to be good participants, right? As Fab was referring to, how do you know they're going to actually add value to your project? Sure, all VCs aren't great, but at least when you sell tokens to a VC, you know who you're getting in bed with, right? And you can tie them to certain things. You can say, okay, you said you're going to help me with this. If you don't, right, I can badmouth you and other founders are not going to work with you. I can say legally your tokens, vest over this amount of time. So you can kind of set conditions easier than the alternative. And so we've seen this progression away from purely permissionless to this kind of system where now teams raise multiple rounds only from accredited investors. And then only then is the first time that kind of the average person, the average user can actually get involved with the token. That is beneficial, again, for reducing regulatory risk, but obviously it comes at a huge cost of now you have these projects that are like VC funded that have no organic community. And so they're trying to like retroactively build an organic community after the fact. And that's just very, very difficult to do. One of the superpowers of ICOs was that you immediately had this loyal, incentive aligned, really powerful community behind you.
Absolutely. And let's talk a little bit about, I feel like companies have tried to do this and like get communities with like airdrops, but there's always a funny phrase. It's like, if you have to pay people to use your product, product probably sucks.
Yeah.
But
sorry, go ahead, Jax.
I'll continue, Matty.
Well, I was just going to quickly add, I think selling a token is very different mentality, right? Or buying a token is very different mentality than getting it for free, right? And I think that skews the kind of way that those two tools are used. But yeah, keen to hear your thoughts.
No, I think that's a very good perspective. I hadn't thought much about that. It's like the skin in the game analogy. I guess people are, usually when I talked with the team from X Plus, they talked about how the difficulty for most Web3 marketers is trying to convert Airdrop Hunter into like reliable community member, which I'm curious, Fabrizio, if you think that's a possible thing. It seems like Matty does not think that's possible.
Yeah, I think I'd back that up. I mean, like, it's notoriously difficult, right? Because you're attracting a particular type of person with like claim-free money, right? Like that's a particular type of demographic that you'll attract, right? And from the founder's perspective, right, you hopefully will probably slaving, I don't know, 14, 16 hours a day to come up with a product. And at least hopefully if you're long-term thinking, you essentially want to maximize the dollar or maximize value per dollar raised, right? And when we talk about community, I mean, community typically gets this bad rap as like, dumb money, retail, they're the ones that, you exit on, they become exit liquidity. But I think it's like, when we talk about community, like there's a lot of really valuable contributors and a lot of really valuable ways people can get involved in projects. But which we didn't touch on before in the introduction, both Matty and myself, we've founded ventures before, we've worked with teams before, we've run DeFi protocols, we've built some communities, right? It's like, unless you go through that, you don't really get the strong appreciation to be like, today it was like this, like a real average day. I don't know, something bad in the market happened, but you still have people out there like fighting FUD or like, rallying behind you. I think it's like, you want to have that incentive alignment with high quality individuals. Where the question before is like, okay, you're giving people some free money. That's going to attract people that just want free money and not stick around. It's like, I don't know. It's like, that like the Prince from Nigeria scam, right? They make it so obvious that it's a scam that only the people that would fall for it actually end up moving and progressing down the funnel, right? And it's like, you might think about that, like, oh, who the hell would fall for that? But they do it on purpose because they want to optimize for the type of person they bring through the funnel. It's kind of the opposite at the moment with a lot of the stuff in airdrop.
Yeah, I've definitely fallen for the free stuff at grocery stores where they have the free cubes of cheese, and I'm very hungry, so I stick around.
Samples?
But I don't know if that works in Cryptolandia, so you guys tell me. But let's talk a little bit about, you guys have mentioned how it's so important to build the community, and in the ICO process, like you were getting people to buy in. Talk to us a little bit about, like, if you were starting a venture from scratch, how would you recommend people build community?
Yeah, I think it's a great question. There's a lot of it that goes to getting people meaningfully involved at an early stage, and that's not necessarily all about token ownership or literal ownership, kind of the protocol, but people, like to feel that they're having an impact and feel that the token price is, going up or the project is progressing because of their efforts, right? Even if it's not really true, even if it's a remote, tiny portion of the success of the project they actually contributed to, people like to feel that they're having that impact. And so getting people involved at the earliest stage, right? Getting people involved in the design review and testing new features and giving feedback and suggesting, hey, have we thought about this? Could we try this? These are all aspects that really engender a really powerful, motivated community. I mean, sure, there's memes and this sort of stuff too, right? Like developing its own language and its own kind of imagery that people can now recognize, oh, you're a member of this group, even just immediately. And that comes along with it. But I think that is also kind of hollow if you don't have some larger common goal that people feel that they're working towards. Fab, would love to hear, your thoughts as well.
Yeah, I mean, spot on. I think, like, if you're going to break this down to a formula, it's kind of like, significant upside, make people rich. Effort attribution, as Matty said, people believe that, they're contributing in a meaningful way, which is moving into a positive impact. And then the third one is around cultural alignment or belief of where this thing's moving to, right? I think it's like combining these three things together is like, not only do you get good incentive alignment and people rallying around for their own upside, but you also start to form like bonds. This is kind of what people talk about around like cult-like communities, right? It's kind of like, NFTs do this really well. Some NFTs do this very well, I should say. A few NFTs do this very well, I should probably say. But I think it's like that essentially is like, humans are very complicated creatures. There's different social dynamics at play, but I think it's like you give people, the option to essentially make it, right? They're happy to throw away their 9-to-5 job and just be contributing all the time. Again, the effort attribution. And then third is like some element of like cultural fit or mission alignment or belief. And, that third point is typically driven by founders that are very prevalent and interesting to follow. There's a lot of very famous main characters that have come and gone, but they really attract that particular type of culture.
Absolutely. And for maybe Building Web3, we'll have everyone get matching face tats just to really quickly distinguish in conferences who is who. But let's talk a little bit about how we can make ICOs great again, because that's what we're all here for.
Yeah. I think for that aspect, to understand that, it goes back to what were the problems, or why did ICOs kind of, like, why did they evolve from that state in the good old days to, the current marketplace? I think it comes down to two things, as we just talked about. There's the regulatory risk with projects. If you speak to them, right, just ask these founders, ask these teams, why are you doing, an airdrop, or why are you not doing a token sale? The first thing that 90% of people answer is regulatory risk, right? And so that needs to be mitigated. Teams need a way to have themselves protected from, let alone going to prison, even just wasting all the money they just raised on legal bills. But the second piece of it is the quality, as Fab mentioned, like the value add per dollar raised you're getting, right? For better or worse, teams perceive this value of raising from a VC. You get this high signal, you get this like big investor name that you get to put associated with your brand, you get introductions to everyone in their network. There is a lot of value associated with raising, especially from a top tier VC. Compare that to raising from a bunch of, wallets that could have just been involved in your competitor's sale, then dumped their token and are now just coming to yours. You don't know what you're getting when you sell tokens to the, to average, pseudonymous people. So a reputation layer, an accountability layer is also a big missing piece. So in my mind, it's regulatory risk, mitigating that, and then also ensuring that you're getting the maximum bang for your buck from the project's point of view. And maybe Fab, you want to speak to the reputation and that accountability a bit more?
Yeah, definitely. I think it's spot on, right? I mean, like in private markets, as Matty says before, you get this two-way opt-in where, founding teams will speak to VCs or angels. VCs, angels will speak to the founding teams. They both do due diligence and say, hey, we like these guys, we don't like these guys. We'll write a check, we won't write a check, right? And I think it's like that's the start of a relationship where these teams have a reasonable understanding of what value they'll get back from this, firm, organization, angel, whatever it might be. And then they're both sort of aligned for a long term, right? Typically with vesting periods. But again, primary incentive alignment. They want to see the project do well, better for their investment. I think it's like, as Matty says, you don't get that right now in the public markets. I think for us, the vision of where we see things moving is not like, VCs are bad, right? There's some real average VCs. There's some really great VCs. But for us, we kind of see them like co-living together where you get the venture capital, you get the benefits you get from that. Like Matty says, the brand signal, you get the advice, you get the experience, you get the large checks, you leverage their network. But then on top of that, at the same time, you're also getting, the crazy cult-like community. But the differentiation here is that you should have that same two-way opt-in you get in private markets and have some way of applying that to the public markets, right? So that's kind of what we talk about is like, of course, regulations changing. We saw the whole reason ICOs died away in the 2018-19 era was that regulation. If you look at charts, you just see amount of money raised. 2019 comes along, almost like the lunar chart, down only. And then, now we're having like market and crypto assets and EU now opening up, becoming more accustomed to the idea, all like centered on this idea of just, better disclosures from projects. So I think it's like compounding the reputation layer that we're speaking about with the times and change of regulation. I think that's the formula of bringing back something that people, they've got a lot of passion for, because really in the end of the day, people in this space that are contributing in a meaningful way, they just want to get in and invest in projects that they believe about in a fair valuation, and they want to contribute to them. And that's kind of the whole ethos of Web3, right?
Absolutely. And let's talk a little bit about like how you guys are trying to help enable this. Is it, hey, wallets are now going to get some kind of, I don't know, we'll call it like a loyalty score or something? Like, talk to us a little bit of how you see this improving in the future.
Yeah, I guess we kicked this off by saying it's a very complex problem, right? I think some people have tried to do this before. People spend their whole life just looking at like on-chain reputation. I think this comes down to mixing not just quantitative information, not just qualitative, but we need some sort of mechanism that takes both the qualitative information, such as, like Matty is bloody good at tokenomics. He wrote Tokenomics built for builders. It gets raved about every conference we go to. People are always like, oh, you're Matty Tokenomics, right? Take some of that qualitative information and then tie that in with quantitative information, right? So there's some level of mechanism of making this scale. We won't go into too much detail. I think there's kind of the secret sauce that we've been cooking up for a while. But it's looking at, people bring value in different ways. Trying to come up with a single way to quantify everything, again, is very difficult. But we're sort of looking for like T-shape individuals. So someone that has, reasonable understanding of a broad capability of things, but ideally they can go deep in a particular area. This might be social. You might have like classic, like a KOL might have a good following. But instead of being on, how many followers do you have? 1 million, right? It's more around the quality of followers that you have. So you can have 1 million and be followed by people that don't do much, or you can have 10 followers followed by Vitalik, for example. And then that particular one should get rated higher. So there's different mechanisms, and I'll let Matt speak to the algorithm on that. But come back to it, it's like different buckets. Might be social, might be a developer, You might spend all your time doing on-chain degen stuff. Tie that stuff in with the qualitative information that you can get from different recommendations. Tie that in with investors able to add information on their investor profile around what they think their main value add is. Are they a passive investor? Are they just going to write money, or do they also want to get actively involved? And I think it's like tying everything here together is quite important. Then taking that information is kind of like, that's a snapshot in time. The more important thing is like over time, how this evolves. So what's your behavior like? Do you join projects and you get endorsed by particular founders for doing something fantastic? Or did you stay passive the whole time, but you jumped on a 10-minute call with the founders that completely pivoted the protocol and made them heaps of money, right? It's like, how do you recognize people for those efforts and sort of create that whole mechanism? And again, that creates this flywheel where people continue to work, you get rewarded, you're essentially optimizing for value add network participants to be part of these projects. They get better upside, projects get better outcomes.
And then, Matty, could you talk a little bit about like what goes into that? Because to me, all these like qualitative measures seem quite difficult to like put into an actual like token distribution cap table.
Mm-hmm. Yeah, so I mean the idea, as Fab was referring to, is people are complex. There's various different aspects, metrics that they have strengths and weaknesses on, and so we try to capture a representation of all those aspects. People kind of have control. They can optionally connect their profile with other things they're already using, and we can use that to score them across these various attributes. And then, tying in the qualitative, I mean, it's also very important what people say about you, and so we leverage things like if you're familiar with it, the eigentrust type of algorithms for reputation. Eigentrust is not to get too in the details, but it basically came up in the context of nodes sharing files with each other, like back in the BitTorrent days. And the idea was, how can I trust a host that I've never contacted before, right? And well, if I know you, Jax, and Jax, you know Fab, and you tell me that, hey, you trust me, trust Fab, I'm going to trust Fab a little bit, right? I'm going to trust Fab at least more than a random person, and that level of trust is going to be conditional on how much do I trust you and how much do you trust Fab. And so we have these kind of social graph networks that start to weight that qualitative input, and so teams can then customize and say, we want to give custom allocations or custom discounts or custom whitelisting to people who have these sorts of characteristics, right? This type of on-chain behavior, or strengths in this area, or people well connected to these types of people, right? Or this list of people. So you can really deeply customize the offering and who you're raising from. And so you're assembling this legion of followers, like your crypto army, that is super customized and passionate about your project and has the skill set and the connections to carry that particular project forward.
Yeah, this is quite curious because this is the first time I've heard of this system. So let's say I'm rating Fab a 10 because Fab's a 10, but you have your own trust score for me personally, and then you discount my trust score of Fab based on your trust of me.
Yeah, essentially, I mean, with the eigentrust type of approach, you get two things. One is you can calculate like a global score for everyone because you can just iteratively see, okay, here are the chains of trust, and we can arrive at this kind of overall representation of trust, if you will. But the other super powerful thing is you can take it from the perspective of any given person, and you can say, Jax, given who you trust, here's the trust scores of everyone else in the systems for you, right? Based on who you initially trust. And so again, this really lets teams customize. We want to go after these particular people, or maybe even customize that further of we want to go after people who are trusted or worked with or know this set of people, right? And so you can deeply customize who you're reaching. You can kind of get the benefits of a widespread token distribution that an airdrop offers without the downside of airdrops of people just dump it. It doesn't convert into loyalty at all. If you look at all the analysis, right, like airdrops are horrible tools for actually gaining users or loyal community. It's basically just a marketing expense. And so we're trying to solve that problem of saying token distributions are the most powerful way of getting attention. Why are you wasting that attention on mercenaries and bots? We should use that attention to build a fantastic, skilled, value-add, loyal community that is aligned with your incentives and going to stick with you long term.
Absolutely. And let's talk for people that are, unfamiliar with Legion. Are you guys building like a tech platform? Is this more of like a, quantitative system that you would sell directly to a founder? Like talk to them through like if they're a founder and they're like, "Hey, I'm interested in this," how it would all work.
User-facing product. Yeah, I mean, like we've been building this for a while, to be honest. The devs have been cooking for a very long time. Not only, of course, to put a lot of the stuff in the back end together, but also build the smart contracts, facilitating the sales, tying in the branding, building at the front end, building at the UI. So this very much will be direct to consumer type of product. Projects that want to speak to us. I think one thing we probably haven't touched on here is that, one of the downsides that we talked about ICOs is that it's token dependent, right? You have a liquid token immediately. And if you've ever launched a token before and tried building a product at the same time, if you don't really know where that product's going, you don't really have a defined roadmap, or you haven't found product market fit yet, it can hinder your growth, or at least your freedom, enormously. So, I mean, one of the things that came out of that is like raising in multiple rounds. Very beneficial, right? It de-risks the investment. It helps founders have flexibility. So not only do we support these token sales at the end stage, but we also facilitate in a compliant way these pre-liquid token sales. So, you could have investors that get access to a pre-seed round or a strategic round or 6 months before the token goes live, because they're looking to optimize for a particular thing. But I thought that's definitely something important to call out.
And then founders looking to, get on board in this system, would they speak directly to you guys? There's like some kind of landing page. Like how would a founder, kind of get started with Legion?
Legion.cc, top of the thing. Your apply as a project. It's as easy it is. Comes directly into Matty and my inbox, and we take it from there.
Well, we love that. So let's talk about some of the challenges you guys faced while building Legion. I'm sure this was not an easy thing to rebuild the ICO model in a more fair and equitable way. So talk to us a little bit about some of the challenges you guys encountered and how you worked to overcome them.
Yeah, I mean, I think the biggest challenge is what Fab mentioned earlier. Like this is a complex problem, right? Of expressing kind of who is a useful investor to have and why, right? And why you want to have them. There's a number of problems behind the scenes, and we kind of we've seen other projects try to fix this area, and largely it's just been like, oh, we think this sale mechanism will fix the problem, right? Or like having a better branded website will fix the problem. And no, not really. So we took a step back, we dug in, we've spoken to hundreds of projects, right? And VC investors, and understood what are the incentives at play. What is actually the true reason teams are not doing this? Is it a lack of will? Do they not perceive the value? And again, largely it comes down to they all want the community. They all want to do this all else equal, but they can't tolerate the regulatory risk and the kind of reputation or investor quality risk, if you will. And so that's why we focused on those aspects. And yeah, especially building, I mean, both those aspects were super difficult and pain in the butt. Fab, maybe you want to dive in more details.
Yeah, well, I don't even know the details, but I was going to say the regulation component. I've never filled out more documents in my life than the last 6 months. It's extreme overhead, but I figure if we can go through it, make it a whole lot easier for different projects to go through. They don't have to acquire the license; they can leverage the license that we have. I think that's super beneficial.
Absolutely, and I know it would be crazy of me to not talk a little bit about tokenomics while we have the master on the call. So if we have a new founder, someone looking to enter the Web3 space, maybe they did like a Web2 startup in tech, but they're looking at the landscape. Like, what would you say is the 80-20 of tokenomics, and what are the things like people really need to know about?
Yeah, I think as with designing any system, like keep it simple, stupid, right? Like the more overwrought and the more complex, it's easy to fall into that kind of rabbit hole of like, oh, if we tack on this aspect, and then if we add that, and then it just gets so complex that no one knows what's happening. And it's just it might have worked back in the like 2020 days and the kind of, the yield farming days with like 4 or 5 figure APYs, but the market has matured since then. So recognize that the market has matured. If you're using comparable projects from 4 years ago or multiple cycles ago, probably not the best template to work off of. So look at contemporary modern examples as a starting place, keep things simple, and always think about the demand and the incentives not just the supply, right? So many projects or so many people, when you ask them, what's the tokenomics? All they talk about is the pie chart. And that is just one aspect of the whole picture. So keep it simple, use contemporary, comparables, and think about demand and incentives.
And then for, let's say a new founder's coming in, they're like, man, I hear what you're saying. Keep it simple. How do I keep it simple? Is there like a template where they can be like, I'm going to copy the tokenomics from Eigenlayer, or like talk to us a little bit about like, are there like just easy libraries you can import that will determine your tokenomics?
Yeah, it's a great question, because I don't think there is too much on the market like that.
Business idea.
Yeah, well, there's one. I mean, so we're partnered with a company that does that. They're called Forged, Forgd. I think I would recommend them. They're a partner of ours, partner of Legion's. So looking forward to working with them in a deeper way on that. And then also the book I've written that Fabrizio mentioned, Tokenomics for Builders. You can find it via my Twitter. You can find it if you just Google for it. It's free, open source, has a lot of background information and templates to start working from.
There we go. All right. So if Legion is successful, which I know it will be, talk to us a little bit about like where you guys hope this will, or what you hope the impact will be on Web3. And I'll start with you, Fabrizio.
Yeah, it will fundamentally change the way projects look to raise capital. Right? It becomes hopefully in 5 years, we look back and it's so blatantly obvious that, involving community members or high value community members at the earliest stages with venture capital leads to the best long-term outcomes. I'd love to get to a place, and Matty can speak to this, around particular standards are set. We start thinking about things more than just TGE or just single cycles or just bear and bulls. We start building projects that actually have meaningful impact over a longer period of time. For me, again, I feel like where capital is being allocated into a particular industry basically drives the direction of that industry. It can either stifle it if that capital is removed, or can lead to amazing things if that capital is directed into a correct place. I feel like capital formation is one of the killer use cases of blockchain and crypto technology. It has to be used for this to grow the industry into a particular way that has larger impact.
Yeah, I mean, I think just echo that. I think that's exactly right. Like, I would hope that in hindsight, we'll look back at this period and be like, what the hell were we doing, raising only from VCs and not building any kind of organic community, and then trying to do that later, right? By the time it's too late to do that in a meaningful way. Look at all the, successful kind of ICOs like, Chainlink with the Link Marines, right? And Thorchain, the Thorchads. You have these super passionate, super motivated communities that were born out of those initial token sales and ICOs. When was the last time you've seen a passionate community born from an airdrop, right? Or born from a VC taking all the first rounds? I can't think of any examples. So, I think it will just be, in hindsight, it will be obvious, and VCs will still be relevant, but it will be smaller, more strategic type of investments and engagement, right? You get like fewer of these kind of predatory, low quality VCs, and more concentrated to top quality, honest, authentic VCs. But then most of the capital formation, most of the community building is happening more organically, more grassroots, which, let's not forget, is how this entire industry started to begin with, right? Bitcoin didn't have any VCs. Bitcoin didn't have anything. All it had was a grassroots organic community.
Absolutely. Now, finally, I'm sure founders out here and builders are thinking like, hey, I'd love to get involved. I think you guys mentioned the website earlier, but call that out again. And then call out any social media, any tokenomics books that people are working on.
Yeah. Fab, do you want to run through the socials?
Sure. I'll wrap her up. Pretty straightforward, to be honest. Website, legion.cc. Social handles on Farcaster and X, formerly Twitter, legion.cc, legion.cc as well. And you can find Matty on Twitter at Matty Tokenomics. _tokenomics, just Matty Tokenomics.
Just Matty Tokenomics, yeah, no underscore.
And you can find me on Twitter at do it different, but it's a 0 instead of an O.
I love it. And the book, where can they find the book?
Tokenomics for Builders. If you just Google that, Google the words Tokenomics for Builders, it'll come up. You can also find it directly on my Twitter. So that's Matty Tokenomics, and it's linked in my profile.
Well, Fabrizio and Matty Tokenomics, thank you so much for joining the Web3 podcast, and all the builders out there. Go look at Legion CC, go get involved, and don't just give all the money to the airdrop hunters, people.
Thank you, Jax. Thanks for having us.